Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following out of the BNN Bloomberg newsroom. We are watching shares of Meta Platforms and NVIDIA today. The news site, tech news site, The Information, reporting Meta's in talks to use Google's AI chips in its data centers by 2027 and may also rent chips from Google's cloud division next year. Investors believe a deal would signal growing momentum for Google's chips, and that's a challenge to NVIDIA's top spot in the space. Shares of Abercrombie and Fitch surging today. The clothing retailer beat on the top and bottom line in its third quarter. Its Hollister brand is doing well. The company raised the low end of its 2026 sales and profit targets. Abercrombie says the quarter was also helped by its pullback on promotions and an improvement in prices. Shares of Zoom Communications seeing a surge today. The video communication company posted revenue that came in above expectations for its most recent quarter, sales jumping more than 4%. Zoom has been pushing a broader range of products and says it's seeing strong momentum with its AI assistant and AI customer experience suite. Here is where we stand on the TSX today, up almost 300 points, 299 right now, to 30,903. It's up 21% over the last year. Taking a look south of the border, the S&P 500 up 60 points right now, almost 1%. The Dow Jones, a 664-point move up, 1.4%. And the Nasdaq, 137-point gain right now, 0.6%. As you saw, North American markets in the green today. My next guest suggests that we may see a rally in Canadian bonds if concerns about a broader market sell-off continue. Let's go to Royce Mendez, Managing Director, Head of Macro Strategy at Desjardins. Thanks for joining us today.
My pleasure.
So it's been a volatile time in which we're seeing some, for example, big tech get hit, but not others. What's the rationale you're seeing play out?
Well, I think there are just generally fears about froth in the market. And so you're seeing some of this materialize into a sell-off, into volatility. There's also questions about the future path of the Federal Reserve. There's questions about the future of inflation within tariffs. So I think there's a lot of concerns out there, and it's resulting just generally in this market volatility we're seeing right now.
All right. Do you see this rotation out as positive?
Yeah, I mean, what you're seeing right now is during times of high volatility, we're seeing inflows into Canadian government bond funds. You're seeing some of the tail risks in these Canadian government bonds receding, and what that translates to is clearly a safe haven bid for Government of Canada bonds, which is really interesting in a time where the Canadian economy is at threat from the trade challenges from the U.S., you're seeing global investors view Canada and specifically Government of Canada bonds as this safe haven asset that they are flowing into during times of high worry and high concern. This is going to help finance the deficit that we're planning to run here in Canada, both at the federal and provincial levels, with more investor demand. It's also going to create an environment of opportunity in 2026 for that money to be put to work into very productive uses. So right now, it's a really interesting time in Canada. While other markets are seeing outflows, Government of Canada bonds are seeing inflows. And actually, it's not only Government of Canada bonds, it's a bunch of Canadian assets that are seeing inflows as global investors rotate a little bit away from the U.S. and towards other jurisdictions that they see as safe and consistently stable. You say global investors, any indication of where the money's coming from? Well, we know that places like China, places like India, these formerly huge participants in the U.S. Treasury market have pulled back. Not necessarily that they're selling in huge amounts, but the margin and dollar of capital they're not putting to work in the U.S. Treasury market. And some of that is spilling over into the Canadian bond market. We're also seeing global central banks that want to park money in a very safe place, look at the government of Canada, see its AAA rating, and think to themselves, hey, I think that's a pretty good place to rotate a little bit of money into. It's a wide swath of investors, all the way from hedge funds to, as I said, central banks and everything in between, that seems to be taking a much closer look at what is going on here in Canada, despite the challenges we face right now with the economy and with trade.
I was going to say, you say Canadians aren't as affected by the market volatility. How so?
Well, if you just look at the household balance sheets in Canada, what they're heavily exposed to is obviously housing. That's not a new story. Everyone knows that. But you compare that to the U.S., where American households are very highly exposed to stocks. They have a lot of their assets in stocks. And so when the market is rising, it's great news. Look, they're feeling wealthier. They're out there spending. But you go through a few months like we've just seen, and potentially a few months in the future where there's further drawdown, and you could start to see American households pulling back because they're feeling poorer. Whereas in Canada, households are not anywhere near as exposed to equities. So this market volatility is not going to shape the future of the Canadian economy the same way it could shape the future of the U.S. economy. Obviously, there are things that are challenges and headwinds here, but the stock market volatility is not high on that list of challenges.
Okay. Also today, U.S. consumer confidence numbers came out. That number is down. Does this signal to you wider concerns?
Look, I mean, it's not great when you see consumer confidence numbers like that, but we have seen a divorce in these surveys between, what they're saying, people are saying, how they're feeling, and then what the economy actually does. So I don't want to put too much stock in that. But generally speaking, there was a whole host of numbers released today. Retail sales, PPI, they all look pretty soft. And I think you can come to a conclusion, a reasonable conclusion, that, the Fed probably should lower interest rates a little bit more. Now, will that help the stock market? Maybe a little bit. But if the Fed also signals that after they cut this one more time, potentially, that they're on hold, that actually may lead to the opposite. It may lead to a further sell-off, with the market pricing significantly more cuts and then having to pull back if the Fed says, okay, after December, we're all done.
Okay, expand your outlook a little bit more for me, because what we're seeing, companies like Best Buy, which did very well in its latest quarter and has raised its guidance because they think Black Friday and also end of year holiday sales they're going to do well for that. But then we see consumer confidence sort of pulling back. So how would you describe the current state of the economy? And I'm talking more generally North America.
Yeah, I mean, I think we're in a fog right now, right? I mean, we are hearing from businesses, but we haven't had a lot of hard economic data in a while out of the U.S. What we're seeing in Canada is sort of middling growth, conflicting signals on growth and inflation. I don't think there's anything clear about the path forward for either the Canadian or the U.S. economy. I think 2026, there are a bunch of challenges that Canada is going to face, not only with regards to the stagnation in the economy currently, but also with regards to the USMCA renewal. In the U.S., there's big questions. I mean, this momentum is clearly slowing. And what comes in 2026, when maybe the effects of all these tariffs start to show up in the inflation numbers, what happens to consumer confidence then? What happens to household spending then? I think there are some really big questions ahead of us. And without data in the past few weeks in the U.S., only getting a trickle right now, we're really in the dark about where we even stand right now.
Yeah, some of that won't come, we know, as you said, till mid-December. Royce Mendez, got to leave it there. So thanks for your time. Royce is Managing Director, Head of Macro Strategy at Desjardins. Alberta and Ottawa getting close to a pipeline deal. Those are the reports. But BC necessarily not on board. More in just a moment. We are hearing from the BC Premier David Eby about that reported pipeline deal between Ottawa and Alberta. A pipeline would likely have to run through BC to get Alberta's oil out to international markets. Let's go to CTV's Colton Prale on this. She joins us now. Colton, what concerns does EB have?
Yeah, three main concerns that the BC Premier raised. The first one was the lack of involvement in the talks, that BC felt that this was the Prime Minister and Alberta talking about their jurisdiction without involving them in that. And he even said that he found out about this reported MOU through the press and then spoke with the Prime Minister yesterday. The other concerns that he have relates to, one, the use of taxpayer dollars in any sort of pipeline project. That's something he's calling to not be included, or if it is, to have a cap on those dollars. And if neither of those are possible, then for BC to be recompensed $50 billion for their own major projects. And then he also wanted to ensure that at the very minimum, Mr. Carney was engaging with coastal First Nations. Of course, we know they oppose this project and would be directly impacted by it. On that final point, the necessity for collaboration with First Nations, the federal government in the last 2 days has been clear it is something that will occur. Yesterday, you saw the Natural Resources Minister, Tim Hodgson, speaking at committee, where he said that the Major Projects Office would clear barriers for any and all projects that it's involved with. But in order to clear those barriers, it would need the support of the local jurisdiction as well as involved First Nations. Today in the House of Commons, when the Prime Minister was challenged by Mr. Poilievre to build a pipeline, the PM was even more clear in his response and what to expect in this upcoming MOU that we think is likely to be announced Thursday. The PM saying it will create the necessary conditions, but not the sufficient conditions for a pipeline, saying that First Nations and BC will have to agree on this. Now, the PM was later challenged whether or not he will bypass them and use federal jurisdiction to get this done. He did not answer those questions. Instead, other ministers stood up and deflected, as is often the case in the House of Commons. But that is the new line of attack from the Conservatives and the opposition as to whether or not the Prime Minister will bypass those other parties. At this point in time, the government signaling that it is not willing to do so, but also that what it is focused on doing, and certainly what we've been hearing from sources about this MOU, is that it's more about trying to skirt some of the regulations that are currently in place to create a regulatory environment for a pipeline project that would incentivize private capital.
Okay, and MOU, we should tell our viewers, Memorandum of Understanding is the agreement that we believe will be announced by the end of the week. Do we know many details about the plans for the pipeline?
So the MOU itself is expected to push the pipeline forward, but it's less about the pipeline and more about the entire energy picture, right? So there's going to be an understanding that likely you need some sort of carve out on the tanker ban in order to make that pipeline work. But crucially, you also need changes to the emissions cap. You need changes to the industrial carbon pricing system, both things that the Prime Minister has highlighted he is open to in his budget. And in order to do those, it is contingent on the development and the implementation of the Pathways carbon capture and storage project, the $16 billion or so from the Pathways companies. And so as much as it's about this pipeline, and there's still much that we'll need to see, it's also going to be on that larger regulatory environment that you've heard oil and gas, and certainly Danielle Smith talking about a lot over the last few months.
All right, CTV's Colton Prale, thank you for that. Appreciate the update. Shares of NVIDIA seeing some pressure today after a report that Meta's in talks to use Google's AI chips in its data centers. And investors believe a deal would signal growing momentum for Google's chips over NVIDIA's. Bloomberg's Ryan Vastelica, has more on this.
Certainly, sentiment has really reversed on Alphabet, and I think people are really appreciating how dominant it is across every layer of the AI stack. Of course, it recently released the latest update to Gemini, which was seen as very strong across all the major benchmarks that people use to evaluate AI models. The chip business is getting a lot of attention lately between the report with Meta and the deal with Anthropic. People really see this as a really significant potential competitor to NVIDIA, as you were discussing earlier. And beyond that, it has a huge cloud business that is seeing accelerating growth. It has so much data and users and distribution and talent. It really has all of the pieces, and that has really helped the stock surge, not just recently, but over the past several months. It is by far the biggest performer, or the best performer of the Mag 7 this year.
I think Counterpoint research analyst and co-founder Neil Shah in a story on Bloomberg saying it's a sleeping giant in the AI race and has fully awoken. But many have been trading for the last few days, ever since Gemini 3 release, maybe going short OpenAI suppliers and long Alphabet suppliers. Is that still bearing out? I'm looking at Oracle down once again, Ryan.
Oracle has really been under a lot of pressure lately. I think it's on track for its biggest one-month drop since 2001, so certainly a real reversal there. It does seem like people are moving towards the Google and Alphabet suppliers, which is companies like Broadcom, while at the same time, the companies that are more connected to OpenAI, you mentioned Oracle, also AMD, Microsoft to a certain extent, these companies have really been under a lot of pressure lately.
It's worth reminding, though, that yes, Alphabet's been on a tear, and actually its valuations have started to trade way higher than we're used to, I think at about 26, 27 times future earnings, but it's still leapfrogged just Microsoft. Ahead of it in terms of market cap is Apple. I think it's got another 7% to go to hit that, but 15% to go to NVIDIA. We're not questioning longer term at this exact moment NVIDIA's dominance in AI and semiconductors.
Well, NVIDIA right now has, I think, 90% or so share of the data center market. If there is potential for Alphabet to start eating into that, I think that would change a lot of calculations for people in terms of how much can Alphabet scale this business. I have talked to someone who thinks that this could potentially be worth more than Alphabet's cloud business, potentially up to $900 billion. So that is a huge potential market there. And if that means that NVIDIA starts losing market share, I think people will start reassessing how to value that company and its growth and its valuation. Now, I will just simply say that the AI market is growing so rapidly that people do see room for a lot of big players, and even Alphabet remains a major customer to NVIDIA just because there is so much demand for compute right now. People don't want to be beholden to any single supplier. It does suggest that there's a lot of room for growth to go around, even if we start seeing some erosion in market share at NVIDIA.
Couche-Tard appears to be seeing signs of a bounce back after reporting second quarter earnings. BNN Bloomberg's Lindsay Biscaya has details on that when we come back. Couche-Tard appears to be bouncing back after reporting second quarter earnings. The stock price also reflecting that today. Let's go to BNN Bloomberg's Lindsay Biscaya. She's been watching the story today. Wow. Okay, so yeah, a bit of a sharp increase there.
Over 4% at the moment, but earlier today it was up around 6%. So obviously a notable gainer today on the TSX. This is actually the most the company's share price has gone up in the last 12 weeks. So this is quite a jump after reporting these earnings. Profit beat expectations. Revenue was slightly below estimates, but most analysts are saying this shows kind of an upward trajectory for the company, especially after last year when Couche-Tard was going all out trying to take over the company behind 7-Eleven, one of their biggest rivals. Focused on that for most of the year, and that takeover did not happen. So now it's really time for Couche-Tard to bounce back and show investors that there's still some confidence there. So net earnings were at $740 million US in this second quarter reported today. That's compared to $708 in the previous year. Total merchandise and service revenues up 6.6% from a year earlier. And the CEO, Alex Miller, was also saying the company reported same-store sales growth in Canada up more than 5%. In the U.S., it was up 1.2%, which doesn't sound like a big number, but that's actually the first time in 7 quarters that same-store sales growth in the U.S. has gone up. And a lot of that growth all over was thanks to food services. So according to the CEO, again, Alex Miller, he's saying he's never had this much confidence in a food services program. And the company saw an increase in hot food sales in particular. So maybe not something you think about when you think of Couche-Tard, of course, a convenience store, but that's kind of where the sales growth is.
Not where I go to get my hot food, but that's just me. Okay, so let's talk about acquisitions forward-looking for this company, because as you mentioned, they went after the 7-Eleven owners last year. That did not pan out. Yes. And this is a company known for acquisitions. Yeah. So what else is in the pipeline?
Well, there's maybe some smaller acquisitions coming. Most analysts are saying that that's something that they would expect of Couche-Tard. But as you mentioned, they have had a lot of acquisitions, 75 in the past 20 years. And we were speaking with Peter Hodson today from I2I Capital Management, and he was talking about how he'd like to see Couche-Tard embark on more kind of large acquisitions. They don't come by very often, but that's what he'd like to see. Here's more on what he had to say.
Of course, they tried to buy a big grocery store chain in France a few years ago. I wouldn't want to see them do like a giant deal, but they absolutely know the retail environment. They know the customers, they know the locations, they know the geographies. So they could certainly do a small tuck-in acquisition and just run it as a retail store and sort of have some cross promotions and things like that. I think that would work very, very well. And then just regular tuck-in acquisitions on the convenience store. And obviously the locations can be very helpful if they ever sort of shift to a massive EV charging operation, which I think is perhaps one of the steps they need to take a little bit more aggressively.
Feels like it, yeah.
Yeah, because they have the absolute locations. They just have to utilize those a little bit better.
And important to note as well, Couche-Tard raised his dividend by about 10% and bought back a lot of its shares, $900 million worth of shares. So Hodson also saying that this is good. They're seeing the company do this with some of that free cash flow they have.
Got it. All right, Lindsay Biscaya, thanks for the updates. Tensions between Canada and the U.S. are causing many snowbirds to opt out of heading to the States this winter. It could even affect travel for American Thanksgiving. CTV's John Venevali-Rao has more.
At Toronto's Pearson Airport, this is typically a busy week for U.S. travel, with American Thanksgiving on Thursday. But this year, the lines may not be as long as usual.
I try my best not to go to the States right now. The whole country's in a conflict.
I am not going to the U.S. at all.
Many travelers continuing to boycott travel stateside since relations with our neighbors remain strained. Something brought up by several American senators from border states over the weekend as they attended an international security conference in Halifax. Some calling Trump's tariffs a mistake, noting not only the economic damage, but how Canadians are responding personally.
But the deeper problem is the cultural break. The idea that Canadians now don't think of Americans as their friends and their neighbors, but as an adversary.
We're your friends, and we're going to do everything we can to put things back to the wonderful relationship that we've always had with Canada.
The troubled state of that relationship reflected in the latest travel data, showing in October return trips by car from the U.S. were down 30% compared to a year ago, and by air they fell 24%. We caught up with Brian Ireland as he headed off on a holiday to Cuba. He says this year he didn't even consider going to Florida.
Not at all. Not at all. We just try to stay clear there right now. We're not involved in the politics, and we're happy to be a Canadian.
A recent poll found 70% said they'd feel uncomfortable traveling to the U.S. this winter. 65% said they were concerned about new border requirements for long-term visitors, including fingerprinting. Still, some of those U.S. senators remain optimistic the damage to relations can eventually be repaired, with one of them, an independent, simply calling the tariffs ridiculous. John Venevali-Rao, CTV News, Toronto.
All right, coming up next, the closing bells on Bay Street and Wall Street. Back in a moment. Here are the closing bells for the end of the trading day. At the NASDAQ, United Way Worldwide ringing the bell. In New York, Epilepsy Foundation of America ringing the bell. And at the TSX, EY Entrepreneur of the Year. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite today gaining 296 points, almost 1% for the day. S&P 500 up 60 points, again, almost 1% on the day. And the NASDAQ, 153-point gain. It's up about 0.7%. Let's get to the movers in Toronto. BRP gaining today close to 8%, $7.23, bringing shares up to 98.23. NovaGold Resources climbing today. It gained 5.8 or 5.9%. It's up 156% on the year, gaining 72 cents today. Denison Mines also moving up today. It gained over 6% or 21 cents. It's up just 5.7% on the year. And then Cameco, uranium company, it gained 4.7% or $5.57 a share, ending the day at 123.18. In the red today, Kelt Explorations. It dropped 5.8% or 45 cents to $7.29. And then Parex down today. It lost 4.5% or 85 cents, ending the day at $17.92. All right, for more on the movers, let's go to Bloomberg's Jeff Morgan. He joins us now. Jeff, there's a report that Meta's looking to Google for chips. Tell us how this played out today.
Yeah, this played out in a very negative way for NVIDIA and a very positive way for Google. Google, one of the companies that providing a lift to the S&P 500 so far today. It was flirting with a $4 trillion valuation. I'm not sure if it quite got there at the very end of the day, but something that we're watching for because this is providing a little bit of momentum for the stock. So a website called The Information reported that Meta is in talks to buy chips from Google as Google's place in kind of the AI pecking order is rising and it has some momentum behind it. There was a handful of sympathy moves as a result. So Broadcom is one of the top performing stocks on the S&P 500 today. Broadcom is a supplier to Google. At the opposite end of the spectrum, you had NVIDIA, which was the biggest drag on the S&P 500 today. So it didn't have the biggest move, but given its size, it was the biggest kind of downward pull on the index. And it had a few sympathy moves as well. So Advanced Micro Devices was a company that fell today. Definitely a dynamic that's worth watching in the coming days here. This, as I said, Google has got a little bit of momentum behind its AI story, and it potentially, at some point, we'll wait to see whether or not it does have that true that customer in Meta.
Okay, let's get to Smuckers. And when we talk about Smuckers, we think jams, but some coffee news from that company today.
That's right. This is, I guess, news you can use. Bad news for the stock, good news for coffee drinkers. So the stock fell today, and part of the reason that it fell is it trimmed its full-year outlook. And the reason it trimmed its full-year outlook is because it is it is not going to go ahead with a coffee price increase. This is the company that owns Folgers Coffee, and they had expected to raise prices as a result of tariffs this winter. Instead, the company said it's going to absorb the $75 million costs of tariffs that it has already paid, and it will not move ahead with a plan to raise prices for those for its coffee offerings as a result. So bad news for the stock, good news for coffee drinkers, and they're getting a little bit of tariff relief, I guess, in exchange here.
All right, Bloomberg, Jeff Morgan, appreciate the update. Thanks for your time.
Thank you.
Let's get to movers south of the border. We have Bloomberg senior equities reporter Bailey Lipschultz there. Bailey, Oracle shares down today. What hit that company?
Yeah, Jeff was talking about it, kind of the rotation away from all the perceived OpenAI winners. Well, Oracle fits into that bucket, but the company also was downgraded over at CFRA, kind of talking down not only their exposure to OpenAI, but also the massive amount of debt that the company does have. So really kind of continuing to lean into the conversations, the bearish sentiment that we've seen percolating here on Wall Street, and obviously with the market under some pressure over the last few weeks. Granted, we've rebounded the last few days, but really centering around what this actually could mean for a company like Oracle. Just looking through that potential total debt exceeding $100 billion. The analysts also saying they expect negative free cash flow through at least fiscal 2028. This is a stock that coming into today's session, where it was among the worst performers of the S&P 500, was down more than 20%. So the bad news seemingly continuing to get bad for Oracle. As you can see, a sharp pullback in the last few weeks, going back to where it was trading not only at the beginning of November, but even late October. So certainly some jitters continuing to play out in that space.
Okay, let's get to Symbotic. Stock up, about 40% today. They do automation. What happened here?
They do automation, but they really are kind of automation of warehouses. So think about it, if you were operating a warehouse for Walmart, their biggest customer, it's actually robots moving around the packages for the most part, as opposed to human beings. So this is a company that beat expectation, talked up their demand, but also unveiled that they have a new customer in Medline, which is a massive healthcare company. They make things like robes and other goods. As a banker put it to me, Medline is a company that if it disappeared, the next time you went to a doctor, you would notice. So as you can see, a big rally today on that 4Q beat, on the fact that the company is diversifying away from Walmart, which has been such a big customer, but also a big shareholder. As you can see, it's a stock that's been caught up in kind of this AI automation wave. The big question is partly around whether or not this was a lot of short covering. It is a heavily shorted and combated name, but definitely seeing a share lift today and getting back towards those levels that it was at just a number of weeks ago.
All right, Bloomberg's Bailey Lipschultz. We'll leave it there. So thanks for your time. And up next, we'll dig back into what's been moving the North American markets, which ended the day in the green. Back in a moment. North American markets in the green for the end of the day. Let's go to Jeffrey Torrey. He's a portfolio manager at Pembroke Management to talk some more about how the day and weeks have been shaking out. Thanks for joining us today.
Yes, happy to be here.
So investors, we know, have been overly confident about big tech. You think they are now questioning that?
Well, you've seen since last week's NVIDIA earnings announcement where you had almost, I don't want to call it like a schizophrenic reaction, but markets going up and then going down very quickly. I think that there's a lot of very sort of high expectations built into big tech. In fairness, though, if you look in the last 4 or 5 years, it's been earned. And if you look at the earnings results from, the Mag 7, which are widely owned and obviously widely loved, they've done very, very well. And so I would say that, it's hard to say that that hasn't been fundamentally earned. The question then now is, are people baking in too high expectations for things? And then, of course, there's been lots of comments more recently about, are we in a bubble? And then just the fact that so many people are talking about it, at least there's, that thinking is possibly reflected in the stock prices. It's hard to know if we're in a bubble. I would say if you were to ask me that I'm on bubble watch would be one way of thinking about it.
Okay, let's talk about high demand for a moment, because as we know, investors are thinking there has to be return on all that spending for AI. Is it too early to ask that, or are investors right to ask that question right now?
I think it's a fair question to ask, and we've moved from a moment, and we've been in discussions in our group about it, where all of the spending had been funded in the last sort of 5 years or the 3 years from free cash flow, and obviously, as I said to you, the big buyers are very profitable and generating huge free cash flow, but because the spending is going logarithmics, it's tipping into a phase where you saw in the comment on Oracle, where these companies, or a lot of them, are going to have to access the debt markets and capital markets because the planned spending is huge. And so it is fair to ask the question now, yes, that money will be spent, there are end markets, but will there be a return earned? And that is often what ends these cycles, is high spending, capital destruction, debt, and then uncertain end market. Not saying that it's not going to be, it is the next revolution for sure.
Okay, so as you know, Jeffrey, some of the big tech remain strong, pushing up, some being dragged down. What's your take on why the winners are winning, if you see a rationale there?
Well, I hate to say, in terms of the way we look at things, in the short term, I think there's a lot of trading, a lot of emotion, and there's obviously the market's has responded greatly to the whole story of what might come in terms of productivity, profitability. There'll be surely revolutions incited by AI. So I think that it's mostly emotional, what you're seeing. There's obviously, winners and losers. You mentioned Oracle as an example. It's obviously the leveraging that's happening is having people take a dimmer view on the equity. Okay,
you mentioned that you are on bubble watch. What does that really mean? How are you positioning for that?
So I think what it means is that I would, exhort your listeners to ask themselves 5 years ago, when did they intend, whether it was through index exposure or their investments, to have such an incredible sort of exposure to technology? And if I go back, I was obviously in the investment business in '99. There was the law of unintended consequences. People who own Nortel did spectacularly well. It got up at one stage to more than 30% of the TSX. If you had asked people in hindsight, was that the asset allocation they wanted? So the advice I'm giving to clients now with their planning is to just be thoughtful about their exposures now, and then the advice we give our clients is to actually think about rebalancing. And yes, you have to pay taxes, but if, and I've read some super interesting articles and some very sage investment sort of gurus they're writing is that they think that, if something bad happens, that there could be compression in valuation and maybe the earnings trajectory flattens. So it's more just about exposure. And so when we talk about bubble watch, is that there's a bunch of factors one looks for in a bubble. They're not all present now, but for sure the spending plans in the next years do sort of reek of frenzy in some ways, but for something that could be game changing.
Okay, where are you these days then on small caps in Canada? And are there certain stocks you're watching in that realm?
So the Canadian small cap market has been a great place to invest, but has fallen out of favor really over 2 decades, caused by the pension funds leaving the Canadian stock market. That's been talked about and written. You've even had people on your show, I think. And then the other part that's less well understood is the change in retail market structure, where investors have been pushed into larger cap products advised by the banks, and then the whole trend of indexing. There was I was at a conference this week where over 50% of investments are now indexed. That has a profound effect on smaller stocks that might not be in the index. And you think, in a way, you describe them as actors without audiences. They're doing their thing, but their audience is a lot narrower than it used to be. And so it's made capital formation in Canada in particular a lot harder. 2 IPOs in 2 years is, kind of sad in a way when you think about every great company in Canada at one stage was an IPO. And then there's almost a circular argument about indexing. Well, if it's not in the index, how will it get in the index? And so it has to earn its way, is the way to think about it. And so despite the tough conditions, there is actually a pretty active group following small cap stocks in Canada. And there's actually a burgeoning group of companies that are earning their way out of obscurity. And those companies have done very well. I think I provided some of those charts to you, where the profits have been great. There was a cycle of discovery where investors embrace the stocks. And then more importantly, as they sort of achieve a level of recognition, the capital markets have opened up to them. So it's kind of proof in a way that the market does work. It's just a question of these companies achieving a level of visibility that allows them to be less undervalued, if you want to call it that. And then the sad part of what's going on in Canada is, in many of the aligned companies, this ignoring of the smaller companies that's happening, it's leading to a huge spate of privatizations. I think we've lost 35 companies since the beginning of 2023, and all of them at significant premiums. But then I spoke about it before when I was on this show, is that money, the future is then lost for the next generation of investors. So it's not a good thing. So that's why I'm so keen to support these smaller companies in Canada.
Jeffrey, I've got to leave it there, sir. Appreciate your time with us, though. Jeffrey Torrey is a portfolio manager with Pembroke Management. Up next, Abercrombie and Fitch stock surging today. We'll break that down when we come back. Shares of Abercrombie and Fitch soaring today. The retailer beat estimates and raised its annual profit forecast. Our next guest sees over 30% upside to the stock. Let's go to Janine Stichter, Managing Director, BTIG. Thanks for joining us today.
Thanks for having me. Good afternoon.
So revenue was up 7% year over year. The company owns Hollister. That's the brand that's doing pretty well. So what age group does it target, and what have they been getting right?
So Hollister targets a teen consumer. It's typically ages 15 to 20, so squarely right in that Gen Z customer that we hear so much about. Whereas Abercrombie, a lot of people think of it as a teen brand. They've moved older and more upmarket over the last 2 years, and they're targeting a millennial consumer, so probably in the 25 to age 40 cohort. And what they've been getting right at Hollister is really the fashion and the branding. This is a brand that for a long time did lose market share, and they've really found their way, leveraging a lot of what we've seen at the Abercrombie brand, that same playbook of getting the product right, getting the marketing right. They're now doing that at the Hollister brand.
All right. Is it mostly sales in the U.S. that are gaining momentum, or is it elsewhere?
It's primarily a U.S. story right now. EMEA, in Europe, they've also been seeing some traction, particularly with Hollister, mostly in the UK and in Germany. APAC has been a bit more challenging, but we think that there's a lot of opportunity there. But right now, this is primarily a U.S. story where they just have a lot of momentum with the U.S. young consumer.
Okay, U.S. consumer confidence is low. That number came out today. Should this retailer and others be looking to a strong holiday season given that scenario?
Yeah, it's interesting. There's definitely a disconnect between some of the headline numbers around consumer sentiment and what we're seeing companies say about the start to holiday. From everything we've heard, the consumer is still spending where they want to spend. And I think a lot of it comes down to having the right product, having the right messaging, and then also kind of being tuned into the fact that the consumer does want value. So I'll give you one example. Over the past week, Abercrombie has started their Black Friday messaging. They're messaging 25 to 50% off the whole store. In reality, most of the store is more 25% off, not 50% off. But they know that that 50% number is going to get a lot of eyeballs, get people to pay attention, and get people to at least come in the door and consider spending with them. So I think it's about messaging and having the right product at this point.
Okay. They also have an NFL collaboration. Has that kicked off yet?
Yeah, the NFL collaboration has been, they kicked it off last year in a smaller way, and then this year expanded it for the Abercrombie brand. It's been really successful. I think one thing that's been really interesting to see is that the Abercrombie brand turnaround hasn't been just women, it's been with men as well. And I think that NFL collaboration is a really big part of that.
The company's been buying back shares. Janine, where do they stand for that? Are they on track?
Yeah, they're actually ahead of plan. They had guided to $400 million in buybacks for the year. Now they're planning $450 million. So it sounds like they bought a bit back more than planned, either towards the end of Q3 or at the start of Q4. And I think what they saw there was a stock that is trading at a very inexpensive multiple. They feel like the business is back on track, and they saw that opportunity to deploy cash to accelerate their buyback plans.
Let me ask you about tariffs. We know sometimes a lot of these garment or apparel companies source from Asia. Tariffs have been sort of up and down for the past, since April. How have they managed to work with the tariff situation?
Yeah, the tariffs are a headwind for this company. If you look at Q3, they were a little bit over 200 basis points of headwind from tariffs. Q4, they'll be going up to about 350 or so basis points. But I think that's going to be the worst of it. What we're hearing from them is that starting in the first quarter of next year into the back half, they'll be able to offset the vast majority of price increases. They're going to be very strategic about it, but they will be taking price through vendor concessions, through reworking their sourcing into different regions where maybe the tariffs aren't as onerous as they are in, say, China or Vietnam. So they're able to offset most of it, but right now it is a pressure on margins.
All right. So how are the rivals in that same space? Who would their rivals be? Would it be someone like Gap?
Yeah, I think on some level, Gap does compete with Abercrombie just because you're looking at a kind of millennial consumer that with a strong foundation in denim. So that's part of it. But I'd say the bigger competitors would be companies like Aritzia, another Canadian company there who very much plays in the space Abercrombie plays, and they're doing very well right now. Another one on kind of the teen space would be American Eagle. We'll hear from them next week, but they've seen a nice turnaround in Q2 into Q3, and we think their holiday's off to a pretty decent start as well. So overall, I think that young consumer does seem to be coming out to spend despite headlines that would suggest that they're pulling back.
Let me ask you about price target for Abercrombie and tell me why you think it's going to go where it's going to go.
Yeah, so the backdrop of how we think about Abercrombie is that people have been assuming that because they have outperformed so much since COVID, that the estimates are going to normalize. And I think some of the weakness of the Abercrombie brand to start the year kind of fueled those concerns. We think they can earn at least $10 in earnings next year, assuming that they get back to a multiple that's even close to their historical levels, even close to peers. We're using a 12 times PE multiple. That gets you to our price target, which is $118. So you just have to assume that they can hold their earnings estimates where they are right now, and that the multiple can, once we get that confidence back from investors, that the multiple can re-expand back towards historical averages, not even surpassing it, but just kind of trading in line with historicals.
All right, Janine Stickler, thank you for joining us. Appreciate your time. Janine is with BTIG. Coming up, shares of Best Buy getting a lift after that company raised guidance for the current year. Back in a moment. Here are the stories we're following in the newsroom today. Reports Ottawa and Alberta have agreed to support a new oil pipeline to Canada's west coast. The leaders expected to make that announcement on Thursday. The BC Premier is David Eby. He's opposed to the plan that would see a line run through his province. Eby has said he wants any potential energy deal between Alberta and Ottawa to include a cap or a ban on the use of taxpayer dollars to build a pipeline. Shares of H&R REIT closed higher today. The Canadian Real Estate Investment Trust is selling retail and office properties in Canada and the U.S. for $1.5 billion U.S. H&R says the step is part of its portfolio strategy. Now, earlier in the month, the company ended its strategic review process without a sale. It also reported operating income that missed estimates. Bloomberg reporting Warner Brothers is asking bidders to submit better offers for the corporation. According to the report, Warner has asked potential buyers to submit new sweetened offers by December 1st. The parent company of HBO and CNN put itself up for sale last month. Paramount, Skydance, Comcast, and Netflix are all vying to buy some or all of Warner Brothers. And shares of NVIDIA under pressure today after a report from a site called The Information that Meta's in talks to use Google's AI chips for its data centers by 2027 and may rent chips from Google's cloud division for next year. Investors believe a deal would signal growing momentum for Google's chips that challenges NVIDIA's top spot in the space. A Manitoba school division is asking teachers to reduce the number of homework assignments they give out due to the use of AI by students. CTV's Alex Karpa has more.
A consistent classroom trend has emerged among students over the last few years.
We noticed that the students were having problems with homeworks.
Alain Laberge believes AI and other online tools have played a role in this shift. The school division he works for recently issued new guidelines for teachers recommending that homework be assigned in moderation while encouraging students to read on their downtime at night.
We have not forbid homework. What we're telling them is the easiest thing and one of the best thing is to read.
Laberge believes AI is impacting how students complete their homework.
They would just simply turn around and ask AI questions and just write down the answers, which we believe is not really useful. It's not the way, it's not critical thinking.
Teachers are being asked to be careful of the types of homework they give out to ensure AI isn't being used as a copying tool. Michael Holden believes it makes sense not to be grading work that is being sent home with students.
When I send homework home, I don't know if the student did that on their own or if they had help from a parent or from a sibling or a tutor or, plugging it into Google or plugging it into a chatbot and asking it to answer the questions for them.
Other professors like David Gerhard say finding a balance is important.
Finding some way to allow students to learn the power of these tools, but also learn how to do the material themselves is going to be the balance.
We're not trying to demonize AI. That's not what we want parents to understand. It's just like AI and homework is not necessarily a good combination.
For Laberge, he says he just wants to see students succeed and is confident this policy will keep them on the right path. Alex Karpa, CTV News, Winnipeg.
Shares of Best Buy trading higher today after that company raised guidance for the current fiscal year. This quarter's upbeat results show Best Buy has reversed a revenue slump that lasted from 2022 until May. Michael Baker joins us now, Managing Director, Senior Research Analyst at D.A. Davidson & Co. Thanks for joining us today.
Great to be here. Thank you for having me.
So consumers, I guess, are replacing the older technology with the newer technology. Is this the primary driver of growth for Best Buy?
Absolutely. It is a product cycle story. Everyone bought new laptops when COVID hit in early 2020. The replacement cycle for those types of machines is usually about 4 or 5 years. So we started to see PCs get better right towards the beginning of 2024, and that's just accelerating. Helped a little bit by the Windows changeover, but generally speaking, this is exactly what we would expect from those product cycles. And now we're actually getting a little bit of a benefit in other areas like gaming. The iPhone 17 is actually a surprisingly strong phone. And probably most importantly, from an incremental standpoint, we got TV units positive for the first time in about 4 years this quarter. Dollar's still down because people are trading down to lower end TVs, but units were positive.
Is AI demand part of this? People want the newer technology for AI?
Helping a little bit, Sure, I think, but even without AI, I think people would be ready to trade in their laptops as well. So to me, that's more of an add-on in terms of higher end features and maybe increasing the average selling price of laptops. People are opting for higher end laptops that have those AI features. But again, we think it's more about just the typical product cycle for laptops. They get old. They break, and usually 4 or 5 years is the life cycle until you're ready for a new one.
All right. So what about appliances, home entertainment departments for Best Buy?
Yeah, well, so the home entertainment, in other words, home theater, that's what we think about that in TVs. Again, still negative in dollars, but we thought we saw an important inflection point this quarter, which is that units are up. So that's the first step to seeing some momentum in that category. Home theater is about 20% of their business. So if that can start to comp positively on a dollar basis, that's going to be a huge tailwind. Appliances a little bit tougher, still negative. We don't really see a turn in that yet. That's much more about new home sales. And we're not quite there yet for Best Buy. We think at this point, Home Depot and Lowe's and names like that are probably taking some market share in appliances from Best Buy, because Home Depot and Lowe's do better in the break fix environment. If your appliance breaks, you go to Home Depot or Lowe's. If you're doing a remodel, you might more opt for Best Buy. We're not quite at that remodel cycle yet.
Got it. So the company feels positive about the upcoming holiday season. So both Black Friday, Christmas spending. Is that typically a stronger part of the year for this company? Because you said they've been in a slump for some time.
Yeah, well, when you say stronger part, it's where they earn a lot of their money. So about 35% of their sales and closer to 40% of their profits come in the fourth quarter. So it is their most important season. In terms of the year-over-year growth, that depends. That depends on the year. Last year was actually a little bit softer. This year, they have a little bit of momentum going in. So we'll see. To us, it is a tough spending environment out there right now. Best Buy was one of the better reporters, but we have had a lot of misses this third quarter as well. So we're still a little bit uneasy on consumer spending, but Best Buy does have some momentum. And again, if last year wasn't as strong for Best Buy, that does set up for an easier comparison. So that does help.
U.S. consumer sentiment is low. As you know, we've got sort of that K-shaped look where the higher consumers are spending and the low-end consumers aren't spending as much. When you add that in, could this affect the Christmas season for Best Buy?
We think it could. Yeah, again, we're a little bit concerned that consumer spending will be on the softer side. We've seen a lot of data suggesting some slowing in spending, and I think a lot of that does have to do with slowing employment. So we're a little bit cautious on retail sales, particularly at the lower end. You're right, though, higher end consumers are spending. Best Buy really services all customers, so that they have a nice they have a nice sort of mix of customers. But in general, we are a little bit concerned about consumer spending this holiday sales. That doesn't mean spending will be down. Certainly not negative, but we just don't think it will be as positive as it was in general versus last year.
All right, Michael Baker, I'm going to leave it there. Sure, I'm out of time. Michael's Managing Director, Senior Research Analyst, D.A. Davidson & Co. Thanks for your time. Coming up next, we'll tell you why the Japanese government has proposed an economic stimulus package that's raising concerns about the country's fiscal sustainability. More in a moment. Japan has announced a new $1 trillion stimulus package designed to provide price relief and economic support for the country. But the initiative could have wider implications for the global economy. For more, we were joined by Thomas Urano, Co-Chief Investment Officer, Managing Director at Sage Advisory.
We've had for decades a scenario where funding costs, i.e. interest rates in Japan, have been demonstrably lower than the rest of the world, right? Which made it attractive for international investors to borrow yen or fund in yen and turn around and move those dollars or those yen into other markets around the globe, either in higher yielding or higher returning assets, whether that be fixed income or risk assets. So it's been a scenario where Japan has been able to export capital to the rest of the world, and that capital, of course, found its home in various asset markets. However, as we've seen over the last several years, the yield in Japan, interest rates in Japan have been rising substantially. 10-year JGBs have risen 7x since the fourth quarter of 22. They've gone from 25 basis points to now 1.8%. And the problem with that is, as you include your FX hedge costs into that, suddenly the interest rate differentials make it less attractive or unprofitable even to move assets out of yen or fund in yen and invest overseas.
So this could dry up liquidity or a source of funding that investors and speculators have used for decades?
Sure. So as those funds have moved out of Japan into the rest of the world, if the dynamics of those economics shift, meaning rising JGB yields increase the borrowing cost or make it more attractive for institutional investors in Japan to bring that money home, i.e. repatriate those dollars back into yen, that's going to be some headwinds, right? That's going to be a draw on capital from foreign markets back into Japan's market.
So there's a double whammy here then. Money could be drawn back to Japan to buy domestic money to buy their local bonds, but also there could be a source of funding cut off for the global market.
Sure, right, and that's exactly the risk here that's occurring, right? If this happens in size, and those differentials in funding versus yields abroad, if they become significant enough to motivate investors to move money back towards yen, what does that look like? That could be headwinds for yields abroad, right? As some of those investors have been borrowing in yen and investing in sovereign domestic markets, U.S. yields, European yields, emerging market debt. If that money leaves, it could be a headwind for yields in those markets. It would add FX volatility as you start to think about unwinding hedges and move from foreign markets back to yen. And then I think that would just, in general, be a headwind as a liquidity drain on markets globally.
That's interesting, isn't it? I wonder, could that be, I mean, who knows? It was the failure of an obscure Austrian bank that helped to spark the global depression in the 30s. I wonder, could this be a catalyst?
Sure. I'm not saying that we're going to have a depression, right? No. But I would say one of the tailwinds that's been occurring for decades because of the interest rate differentials in Japan versus the rest of the world has been Japan has been a large exporter of liquidity, right? And maybe that tailwind is drying up. There's been a significant, I'll say, rewriting of yield differentials between Japan and the rest of the world. And if that's the case, then fund flows back towards Japan, or at least a lack of additional flows from Japan into foreign markets, again, could be a headwind for liquidity going forward.
And Japan, it seems like forever, since at least 1989, when I think the previous peak for their market was, it's just had this moribund growth. This new leader in Japan determined to juice that?
Sure. I think if you look at Japanese equities, what are they responding to? Well, on the one hand, $135 billion stimulus package designed to support GDP growth, which has been lagging in Japan, right? So what are they talking about doing? This is the largest package since the pandemic. They're talking about providing energy subsidies, tax cuts, some handouts, basically anything they can to support direct consumption in Japan and GDP growth in Japan. So a positive aspect, to be sure, but also consider the concept too that if there's this repatriation effort, what does that look like? That means some dollars moving back to Japan that can also be supportive for capital markets in Japan.
It is fascinating that I do remember, I think this was prior to the housing crisis, though. People in markets like Hungary were borrowing money at low Japanese interest rates and buying real estate. So this has been going on for a long time, this cheap Japanese funding.
Sure. Yeah. Like I said, Japan has been a funding currency for decades. The fact that differential is changing, I think it's just something investors need to pay attention to, right? If it's a scenario where, funding in local markets in Japan is going to dry up liquidity and depress investment demand for opportunities in foreign markets, it's certainly a headwind for capital appreciation in those assets.
And what about Japan itself? Can you generalize, is the equity market there looking like good value?
I can only say that I think in terms of Japan on the equity side, you have to respond to what the growth picture looks like there. Right? They've been struggling, right? There's a reason the new prime minister is coming on board. There's a reason she's proposing a very substantial stimulus package. Their GDP growth has been weak. It's been sub 1%. For third quarter of this year, it was actually in contraction, down about 40 basis points. So, thinking about equity growth or equities in Japan, I think you have to think about what's the outlook for obviously domestic growth in Japan, but then also, there's some hope involved here that the stimulus package will help drive growth back into positive territory. Targets or estimates are somewhere near 1.25%, maybe 1.5% for 2025. And perhaps the stimulus package could push it a little higher than that.
Thomas Urano is co-chief investment officer and managing partner at Sage Advisory. Coming up is Hot Picks. We'll look at 3 plays in transportation and logistics. Back in a moment. Time now for Hot Picks. We were joined by Jason Seidel, analyst at TD Cowen, to talk about 3 plays in transportation and logistics. And we kick things off with FedEx as his top pick, a company he thinks is positioned to benefit from growth in e-commerce.
FedEx right now, when you look at the where it's trading at roughly in line with its historic average. But remember, the company is going to be breaking out its LTL division for investors. So we're really looking at this thing as a sum of the parts, because your LTL business tends to trade at a much higher multiple than does your parcel portion. Near term, don't expect a lot out of FedEx or even UPS when you're looking at the parcel guys. Peak season expectations, I'd say, are somewhat muted. Your business from your larger customers is probably in line with historical trends in terms of your peak season expectations, where your SMBs are a little bit more muted. In other words, people that probably can't shift as much with the changes in the tariffs and everything else. But the good news is that both FedEx and UPS are remaining very, very disciplined on pricing. Now, you can't overlook a recent tragedy with that UPS had with one of its freighters. The MD-11s are grounded for both carriers right now. It's a workhorse for a lot of them, but it's not a large percentage of either of their fleets. FedEx, it's actually a little bit smaller. It's about 4% versus 9% at UPS. We're expecting these guys to really just sort of shift a little bit more to the ground, maybe deploy some extra spare aircraft and adjust some of the maintenance schedules going forward, and even probably take advantage of some of the belly space of some of the consumer airlines that are out there. Longer term, when you look at FedEx, one of the things I think that excites investors is really looking at the changes that they have in their network that is coming, because most people don't remember that FedEx was actually created by just an air network, and then they added the ground later. So they're really going to be right-sizing their network going forward. Instead of having 2 FedEx truck stop at your house, they're going to try to go to 1 in as many places as possible.
Right, so that was that deadly plane crash in Kentucky, forcing UPS and FedEx to ground their fleet. Yeah, 14 people killed in that one. GXO Logistics, remind us what they're all about and what attracts you there, Jason, please.
Sure. So, when you look at GXO, they're basically an automated warehouse provider and really a supply chain coordinator. When you look at automation in the transportation space, a lot's focused on automated trucks and sort of that's on the come, but it's been on the come for many years right now. There's also automated talk on the rail side, but there's a lot of pushback there as well. There's really no pushback on the warehousing front, and this is where they play. There's a new CEO that came in recently, Patrick Kelleher. He's come over from DHL, very well respected in the supply chain. He's refocusing the company on sort of organic growth and expanding into some areas that tend to be a little bit higher margin. But the really interesting thing about these guys is they tend to lock up long-term contracts, and the renewal rate on these contracts are in the 90+% range. When you look at what they've locked up for 2026 through the third quarter, it's almost where we're expecting them to grow all in. So they've got a lot of their growth already locked in. We suspect when they report 4Q, they'll have almost $1 billion in revenue booked for 2026 in new contracts. So there's an exciting story there, and also a recent acquisition that they did, Wincanton, that was held up by the British regulators, is set to pay some dividends right now. So it was held up, so they really couldn't take advantage of some of the cost savings. We expect that to flow through about $60 million for their EBITDA. And then on top of that, we expect that to allow them to expand more into the A&D consumer base, which should position the company in the years to come.
And then finally, Knight Swift Transportation, KNX in New York. What's distinctive about them, Jason?
Yeah, well, I'll start off by saying in the U.S. trucking space, things are bad. So that's there's no way to get around this right now. But really, and we've been in the downturn, by the way, for over 3 years, the longest I've seen in my 30-plus year career in logistics. That's the bad news. The good news is we're starting to see ways capacity can come out of the marketplace. And a lot of that has been driven by the government. So the FMCSA, which is under the DOT, has issued several rulings. The biggest one out there is the non-domiciled driver ruling. And we estimate that can impact roughly 8% of the capacity over a 2-year period of time. Now, that's stayed in the courts right now. We expect that stayed probably be lifted or maybe sent back to the FMCSA. But that's a lot of capacity to take out of the marketplace, which should, all other things being equal, help pricing. You add on top of that some English language proficiency testing that should take some drivers out of the marketplace, as well as illegally issued CDLs, commercial driver's licenses. Those things will be taking capacity out. Recently, California was hit with 17,000 taken out of the marketplace. That's almost 9% of their CDL capacity. Now, mind you, maybe not all of those were active, but still, this is a way to take that capacity out of the marketplace and provide some much needed help to the U.S. trucking industry, which has been really sort of under the thumb of lower pricing for the better part of, like I said, 3 years.
And just what went on with those driving licenses? There was fraud in the system?
Well, unfortunately, there's been a lot of fraud in the system. I mean, you have what they call CDL mills, which will get you your CDL in 1 day. Think about that. You can get a driver's license to drive an 80,000-pound vehicle in 1 day. There's a lot of issues right now that they're looking to correct, and a lot of it is around safety. So I know there's, a lot of it's been politicized, unfortunately, but when you look at the things that they're doing, the focus is on safety, and that makes a lot of sense.
And is this kind of fraud happening in Canada as well? Can you give us any color on that?
Yeah, Canada's had some issues too with some of the some illegal drivers coming up, sort of setting up shop and then closing down really quickly and moving around. They have their issues as well. So it's not just the U.S. I don't want to paint such a bleak picture for my home country, but it is an absolute problem. And on top of that, you have violations of the cabotage rule, right? Like, so when you're looking at drivers that are supposed to, come in, let's say from Mexico and drop off a load and then go back, they're not allowed to solicit other business once they're in the U.S. And I believe typically they have about 7 days to do so. You're finding a lot of these drivers are staying up to 20 plus days in the country and are probably soliciting other work. So there's a lot of stuff that they're looking at right now to curtail that capacity that's expanded so much sort of post the COVID supply chain situation.
Jason Seidel, analyst, transportation and logistics at TD Cowen. Recap of how we ended today. The TSX gaining almost 300 points on the day, almost up a full percent to 30,900. And that is a new record close for the TSX. North American markets were generally in the green today. We also got some earnings results after the end of the trading day. Let's start with HP. In after hours, you can see that stock moving down, losing almost 5.5% or $1.33. Its profit outlook for the current year fell short of what was estimated. HP says it will cut 4,000 to 6,000 employees by 2028 as it turns to AI. And let's take a look at Dell as well, moving up in after hours trading over 2% after reporting some mixed results. Now, it missed on revenue for the third quarter, but it raised its annual projections for the key AI server market. Thanks for joining us today on The Close. We'll see you back here again tomorrow.